Are you thinking about buying a business but struggling with financing? In this high interest rate market, especially right now, hopefully rates will come down. Obviously, SBA traditionally is variable, but in 2025, a growing number of buyers are turning to seller financing to make deals happen. But what exactly is seller financing and how can it benefit both the buyer and the seller? Stick around. By the end of this video, you'll have a complete understanding of how to structure seller financing deals to maximize cash flow and close your next acquisition. Hi, my name's Trent Lee. I've sold over 600 businesses, and for the last 6 years in a row, I've been named the #1 business broker in the country for the most closed transactions per year. And I make these videos so that one day you'll want to reach out so that I can help you buy or sell a business. So, what is seller financing? Simply, seller financing, also called owner financing, is when the seller offers a loan to the buyer to finance part of the purchase price. Part is key. Very rarely do they offer 100% financing. But let me give you an example. Let's say the business purchase price is $1 million. The buyer's down payment is $300,000 or 30%. Now, let's say you're getting a bank loan for 50%. That leaves a remaining seller financing of 20% or $200,000. This arrangement lowers the buyer's need to borrow from the bank, spreads the risk, and provides the seller with steady cash payments over time. So why is seller financing increasing in 2025? High interest rates are at least driving up borrower cost, which drives up now the debt servicing, and banks are becoming more selective with these loans. Seller financing offers interest rates sometimes between 5 to 8%, typically lower than what you can get a traditional bank loan at, an SBA loan at least currently. This also helps buyers avoid strict underwriting policies where the bank doesn't want to lend as much money if the buyer doesn't have a large down payment. Seller financing can help bridge that gap. So, what are some of the benefits of flexible seller financing loan terms? Seller financing allows for customized terms such as amortized over 10 years, interest-only payments, as in maybe the first year. There could be balloon payments after 3 to 5 years where you may be refinancing it at a lower interest rate down the road. There are also seller financing notes on full standby which make a big impact and are positive for the buyer. It also helps create a lower down payment for the buyer, and cash flow is impacted positively because seller financing can lower the buyer's upfront cash requirements. Here's another example. If a traditional bank financing, if you were to get a $1 million loan with 30% down payment and 20% seller financing, the payments drop to $160,000, leaving more working capital to run the business. This extra capital helps the buyer improve operations. Rather than putting all of that money as a down payment, a combination of a down payment and seller financing frees up more capital for the buyer. There are plenty of benefits for the buyer when it comes to seller financing. The key is, how do you get the seller to agree to that? So here's a couple ways you can do a win-win situation with seller financing for the seller. You can provide a higher purchase price. Sellers can attract more buyers with flexible terms and secure a better deal if there's seller financing involved. Some sellers don't necessarily need or want a lump sum one-time payment. Some, instead of having a one-time lump sum payment all done at closing, sellers can provide and earn monthly principal and interest payments. The buyer, which then creates tax benefits, deferring capital gains tax, allowing sellers to spread their tax liability over time, reducing the immediate burden right at closing, or at least in that taxable year. So if you're considering buying a business, make sure you structure it in a way that benefits the buyer, but in a way that's also incentivized and benefits the seller. When you do that, and when you use a combination of the right type of seller financing coupled with an appropriate down payment, lowering the risk from the bank and how much they're financing, you create a win-win situation for the buyer, for the seller, and the bank, because they're not financing as much as they typically would if you're trying to get a 10% down payment and a 90% bank financing from the loan. Coupling this right deal structure can make the deal very attractive for the bank, for the buyer, and for the seller. So make sure you work with a good experienced broker that knows how and when to use the right type of seller financing to get a deal done. You can benefit from it. Either there'll be a tremendous amount of value and benefits to everyone involved by having a professional team help you through that process.